All right, so we're going to go ahead and get cranked back up, get started. Our next speaker is Marie Young with the National Association of Tax Professionals. Marie's spoken down here 3 or 4 times. Great speaker, wealth of knowledge. Again, we always get great feedback from you regarding her talks. She's going to talk about casualty and theft and disaster losses. So let's give Miss Marie a big warm round of applause.
Thank you. I always appreciate the opportunity to come and speak with Taxslayer. What a great event and a great group of people. It's nice to see familiar faces. I'm with NATP, and we have a booth here in the back in the walkway. I welcome you later today to come by and talk to us and talk to Polly. We're an education facilitator for tax professionals, so stop by and talk to us a little bit. And this year in our country, there's been a lot of disasters and a lot of hurricanes and things that you and I are going to be working with our clients on during tax season. I was in church on Sunday, and my pastor was talking about that, you're at the beach. I love going to the beach. And you're standing in the beach, and you're standing in the waves, and the sand's kind of swirling around you. And then all of a sudden, that wave hits you. And he was telling us that every 6th wave is a rogue wave. And it really made me think, with our taxpayers this year, that they've been hit and taken their knees out from under them with a rogue wave. And as we talk about these casualties and these disaster losses this afternoon. So this afternoon, we know that the IRS allows individuals a deduction for personal casualties that are not compensated by insurance. A theft or taking of money or property, it has to be illegal under the state law. The theft must have a criminal intent, but a conviction is not required. Theft would include maybe blackmail or burglary, embezzlement, robbery. Personal casualty losses, they're deductible to the extent that the total loss exceeds $100, and all casualty losses for the year must exceed 10% of the taxpayer's adjusted gross income. The deduction for these casualty losses is an itemized deduction. The decline in the stock market, while it's painful, is not a theft loss. Misplaced property is not considered a theft loss. But let's say you close your door on your car and you break your diamond ring, and the diamond falls out. And you cannot find the diamond. This would then be a casualty loss. For our taxpayers, we have 3 types of losses. One is personal, and then we have business or income-producing property losses, and then third, we have our Ponzi schemes. An individual for a Ponzi scheme, they hold themselves as an investment advisor, and they receive cash or property from our investors. Then they purport to earn income for the investor. They then report the income amounts to the investors that are either wholly or partially fraudulent. These losses from these Ponzi schemes are then deducted as theft losses. A theft loss is considered an ordinary loss, whereas an investment loss generally is a capital loss subject to or limited to the $3,000 per year. We have Revenue Procedure 2009-20 and 2011-58. These 2 revenue procedures provides a safe harbor where a theft loss deduction is allowed if the qualified investor is a U.S. taxpayer that did not have knowledge of the fraudulent investment arrangement prior to it becoming known to the general public. If an individual's IRA is invested in a Ponzi scheme, the individual cannot claim a theft loss deduction. If the individual has basis in the IRA or the qualified retirement plan, the individual can claim a miscellaneous itemized deduction on Schedule A, subject to 2% of the AGI for any unrecovered basis when the entire interest in the plan or the IRA has been distributed. If that individual has no basis because of all the contributions were deductible, the individual cannot claim a deduction for the economic loss in that plan or that IRA due to the Ponzi scheme. A casualty loss, that's going to be the damage or the destruction or the loss of property resulting from an identifiable event that's either sudden, unexpected, or unusual. A deductible casualty loss can result from a number of different scenarios or causes. It can be a car accident, earthquake, fires, floods, hurricanes, tornadoes. So for example, if your antique ornamental rug was damaged by your new puppy because it was not housebroken, and the damage then was not unsuspected and unusual, the loss would not be deductible as a casualty loss. The steady weakening of a building due to normal wind and weather conditions or due to termite or moth damage is not considered a casualty loss. Our disaster losses occurring in a federally declared disaster area at the election of the taxpayer can be deducted in the year prior to the year of the disaster. A list of the disaster areas are listed on FEMA.gov/disaster, and it's amazing when you pull that website. In 2017, we've had federal disasters in New York, Kansas, South Carolina, Louisiana, California, Florida, Mississippi, Georgia, and there's just many more. So you and I will probably see quite a bit of these with our taxpayers as we're working through their tax returns. The IRS, they can extend normal deadlines for many actions for the taxpayers that are affected by the disasters in these federally declared disaster areas. Our affected individuals and businesses, they have until January 31 of 2018 to file and pay certain taxes. This includes the September 15th and the January 15th estimated taxes. This includes the filing of individual tax returns that were due back in October 15 of 2017. But the taxes were due in April of 17. So this relief is not granted for the payment of the taxes. If the taxpayer files a tax return, it does not matter which spouse owned the property. If the property is owned separately and separate returns are filed, only the spouse who owns the property can deduct the loss. On separate tax returns, jointly owned property must be split even if only one spouse pays for all of the repairs. In our community property states, the loss is allowed only to the extent of the spouse's community interest. For our parents and our children, the loss can be deducted only by the legal owner of the property. For example, an automobile in the child's name, the parent could not claim the casualty loss for that loss that the child incurred, even if that child is the parent's dependent. For our tenants and our landlords, the courts and the IRS seem to contradict each other. The courts denied any loss to a tenant because of either no basis or lack of ownership. In another case, where a tenant had to return the property in the same condition as before the casualty, the IRS allowed the loss to the tenant. For members of a homeowners association, the taxpayer is allowed to use the assessments along with other repairs paid as the amount of the casualty loss when the property is specifically damaged that they own. For us to deduct a casualty loss or a theft loss, the taxpayer must be able to show that there was actually a casualty or a theft. The taxpayer must be able to show the type of the casualty, that it was an accident, a fire, a storm, and when it occurred. They also must be able to show the loss was a direct result of the casualty. If the taxpayer was the owner of the property or the property was leased, we must be able to show that the taxpayer must repair the property minus any insurance or reimbursements received or expected to be received. We also need to show whether a claim for reimbursement exists and if there is a reasonable expectation of recovery of that claim. We have publication 584 and 584B, and this helps us to list and to document those losses. The losses then for casualty loss that's unreimbursable is then deducted in the year the casualty took place, even if that property is not repaired or replaced until a later year. Many of our taxpayers also, they may be surprised to learn that the receipt of an insurance recovery for a fire or a casualty loss may result in a capital gain or a taxable gain for them in that year. This can occur when the insurance reimbursement exceeds the taxpayer's depreciated tax basis. And this will be reported in the year the reimbursement's received. A business owner could elect to purchase a replacement property within 2 years, and this is considered an involuntary conversion. A casualty loss from a federally declared disaster can be deducted in the year before the disaster. Claiming this disaster loss on a previous year could then result in a lower tax for that year. It can often then produce or increase a refund, and this could be advantageous for your taxpayer who needs additional cash due to the disaster. The choice to take this casualty loss for the disaster in the previous year must be made, though, within 6 months after the due date for filing the taxpayer's tax return. For example, a calendar year taxpayer would have till October 15, 2018 to amend their 2016 tax return to claim a loss that occurred in 2017. If a decision is made to do this, a statement then is attached to the return declaring that they're making the choice, including the date of the disaster, the city, the town, the county, and the state where the property was located. To claim a loss in a prior year, we would file the amended return if the return had already been filed. If a taxpayer owns numerous parcels of real estate, all of the losses then are reported in the same year. A taxpayer cannot elect to report a loss on one property in 1 year and then a casualty loss on another property in the current year. For our theft loss, it's claimed in the year it's discovered, unless it's reasonable that there's a belief of recovery, and then it's claimed in the year that they either have the recovery or when they believe they will no longer receive the recovery. This year we have the Disaster Tax Relief and Airport and Airway Extension Act. This was signed into effect on September 29th of 2017 by President Trump. The act provides temporary tax relief to victims of Hurricane Harvey, Irma, and Maria. The relief is for individuals includes loosening restrictions for claiming personal casualty losses, tax-favored withdrawals for retirement accounts, and the option of using current or prior year's income for purposes of claiming the Earned Income Tax Credit and the Child Tax Credit. The Act provides for tax relief for taxpayers who suffered a net disaster loss, which is defined as the excess of qualified disaster-related personal casualty losses over the personal casualty gains. For a taxpayer, generally, they can claim a deduction for a loss sustained during the tax year and not compensated by insurance or reimbursement, but for individuals, a personal loss from a casualty is deductible only to the extent that it exceeds $100 and 10% of AGI. If the loss is incurred in Harvey, Irma, or Maria, the 10% of AGI is eliminated to qualify for this deduction. The Act also eliminates the current requirement that the taxpayers must itemize to claim the tax relief. It does so then by increasing the individual's standard deduction by the net disaster loss. Also, there's no reduction for taxpayers subject to AMT. The Act, which generally disallows the standard deduction for alternative minimum tax purposes, does not apply for this newly increased portion of the standard deduction that's attributed to the net disaster loss. The Act also increases the $100 per casualty to $500 to qualify disaster-related personal casualty losses. With this Act, a number of new rules made it easier for these storm victims to make qualified hurricane distributions up to $100,000 from their retirement account. A qualified hurricane distribution is any distribution from an eligible retirement account that including an IRA. For August 23, 2017 and before January 1, 2019, the individual can take a distribution if their principal residence on August 23rd of 17 is in the Hurricane Harvey disaster area, and if they sustained an economic loss because of the hurricane. September 4th, 2017 to January 1, 2019 because of Hurricane Irma, and September 16 of 17 to January 1 of 2019 because of Hurricane Maria. The qualified distributions are not subject to the early distribution penalty of 10%. Under the old rule, a taxpayer could take a loan from their 401k or a 403b up to half of their retirement account or $50,000 as a maximum, and then it had to be repaid back in 5 years. Under this Relief Act, taxpayers 59 and a half or younger can take a distribution without the 10% penalty. Income resulting from the qualified distributions would be included in income over a 3-year period, so it's spread out over 3 years evenly. A taxpayer also has the option to elect out of the 3-year spreading of that distribution. Under the Act, the qualified distribution can be recontributed at any time over a 3-year period, beginning on the day after the distribution was received. Our qualified distributions under this Act are not subject to the 20% withholding. Certain withdrawals from qualified retirement plans, which were received after February 28th of 17 and before September 21, 17, for a taxpayer who was going to construct or purchase a new home, they can be recontributed back to that plan if the construction was canceled because of one of the hurricanes, either Harvey, Irma, or Maria. The timely recontribution then would avoid taxes on the plan withdrawal, and the recontribution must be made beginning August 23rd of 17, and they have until February 28 of 18 to place those monies back in that account. The maximum amount that a plan participant or a beneficiary can withdraw from a qualified plan, it increased from $50,000 to $100,000, so it removes the 1/2 of the present value limitation. The plan loans have a longer repayment period by delaying the due date on the first payment by 1 year, and then all the future repayments then are delayed as well. Under this plan also, our taxpayers, because maybe their employers were unable to open or because they were unable to go to work, we also have changes regarding the earned income tax credit and the child tax credit. These individuals whose principal residence was located either in the hurricane disaster zone or in the hurricane disaster area, and the individual was displaced from their personal residence by the hurricane on or after the dates of August 23rd or September 4th or September 16th, depending on the type of hurricane, then the taxpayer can use their prior year earned income to calculate their earned income tax credit as well as their child tax credit. So if you find that a taxpayer is able to use their prior year earned income and that it increases that earned income tax credit, you can make this election for this taxpayer. For our joint filers, this election applies if either spouse is the qualified individual in the area. The act that we're talking about also temporarily suspends the majority of the limitation on charitable contributions for qualified contributions paid during August 23rd, 2017 to December 31, 17 for relief efforts into Hurricane Harvey, Irma, or Maria for those disaster areas. The qualified contributions must be substantiated, though, with a receipt, a written acknowledgement that the contribution was made and is to be used for relief efforts, and the taxpayer must make an election for this act. For our partnerships and our S-corps, the election's made separately by each partner and by each shareholder. I also like this part of the act for our employee retention credit. For our employers involved in the hurricane, employers are generally defined as an employer that conducts an active business or trade in that disaster zone area or in a business in the hurricane area, and this credit then continues through January 1, 2018. If the business is considered inoperable, or if it is stated to be that they need time to get back opened. The credit is 40% of up to $6,000 of qualified wages to the employee. An employee, though, cannot take into account more than one time for the purposes of the employee retention tax credit. So, for example, if an employee is an employee with respect to Hurricane Harvey, for the credit, they cannot be an employee for this credit for Irma or Maria. The employee's principal residence of employment on the date of the storm has to be in the hurricane disaster area. So this credit is up to $2,400 per employee. There is conversation, though, because the Act does not discuss, it uses the words inoperable, that the business needs to be inoperable, or it also has to have significant operations. So there is discussion that there is flexibility over what that language exactly means. For our casualty losses and our disaster losses, we report them on a Form 4684. And for our personal use property, we report it on a Schedule A. For our business and income property, Schedule B. And then the Ponzi schemes that we just spoke about on a Schedule C. Our S-Corps and our partnerships, they do not claim the casualty or the disaster loss at the entity level. The loss is a separate pass-through that's then reported on each taxpayer's K-1. If a taxpayer claims an office and home deduction using the Form 8829, the loss is reported on a Schedule B. But if the taxpayer claims an office and home using the simplified method for the home office deduction, the loss is reported on the Schedule A of the Form 4684. Our casualty losses is either the fair market value before the loss minus the fair market value after, or the adjusted basis, whichever is less. We subtract any insurance or any reimbursements received or that are expected to be received from the smaller of that adjusted basis or the decrease in the fair market value. If the reimbursement is more than the adjusted basis, there will be a casualty gain. Taxpayers then can exclude the gain under our Section 121 exclusion for the principal residence. If the business or the income-producing property, such as a rental property, is completely destroyed, and the property's fair market value is less than the adjusted basis before the loss, the entire basis may be deducted as the loss. When this property is not destroyed, the deduction is the change then in the fair market value from the physical damage, but then it's capped at the adjusted basis at the time of that casualty. If that property has been completely depreciated, it has no basis, then no casualty loss will be available to that taxpayer. With our businesses, they have loss of inventory due to these casualties, and we have two ways to deduct the casualty loss for inventory. We could not file the Form 4684, and the loss of inventory is then deducted through cost of goods sold by properly reporting the opening and the closing inventories, and any reimbursement that they receive from insurance is then included in the gross income. Or we can file a Form 4684, and the loss of inventory is deducted separately, and the cost of goods sold is adjusted then by the affected inventory. Either the opening inventory or the purchases is then decreased by that loss on the inventory. Any reimbursement then reduces the amount of that loss. When the loss of inventory, though, is reported on a Form 4684, the loss then flows over to the Schedule A as an itemized deduction, and it does not become a direct business deduction. The primary difference of this would be then for our sole proprietors, they would then not have the reduction for the self-employment income and their self-employment tax if we go through the 4684. The decrease in our fair market value, it's determined in two ways. Either an appraisal, and we need a competent appraiser then to determine the difference between the fair market value of that property immediately before and immediately after the casualty. The appraiser must be familiar with the property before and after the casualty. They need to have knowledge of the area and have knowledge of the conditions in those areas. A taxpayer may be able to use an appraisal that was used to obtain a federal loan as a result of it being in a federally declared area, disaster area, to establish their losses. The cost of repairs after a casualty loss is not a casualty deduction. It's not allowed as part of the loss. But the cost, though, can be used as a measure of the decrease in fair market value if the repairs were actually made. The repairs are maybe necessary to bring that property back to its condition before the casualty. The amount spent on the repairs are not excessive, and the repairs take care of that damage only and do not increase the property value of that area. The cost of restoring landscaping to its original condition after a casualty loss can indicate the decrease in fair market value. The cost that our taxpayers incur, though, to protect that property against a casualty is not part of the casualty loss. The incidental expenses that they incur as personal injuries or temporary housing, car rentals, sentimental value, they are not part of the casualty loss. Insurance and other reimbursements, they must be subtracted from the casualty, from the loss when we're calculating the total casualty loss. It's also important for you and I, when we're making this calculation, to determine what the insurance or the reimbursements are for. For example, in a qualified disaster relief payment that's from FEMA, that may be partially for temporary living expenses and partially for damage to the real or personal property. Our reimbursements, a taxpayer can receive several types of reimbursements, and some are taxable, some are not. For the insurance reimbursement, the loss is reduced by the reimbursement. Insurance reimbursement that is for personal living expenses, they do not reduce the loss. Insurance reimbursement for a business is considered taxable income. Cash gifts that are not restricted can be used they can be used in any manner. They do not reduce the loss that a taxpayer incurs. Our disaster relief funds that are not restricted for damaged property, they do not reduce the loss. Lawsuit monies and settlements, they do reduce the loss. Qualified disaster relief, unless it's restricted, does not reduce the loss. And loans that are used to replace or rehab the property, they do not reduce the loss for the taxpayer. As long as the reimbursement for temporary housing and living expenses do not exceed the temporary increase in living expenses, the reimbursement for temporary housing is not taxable and does not reduce the casualty loss. If the insurance payments are for living expenses and they exceed the temporary increase in living expense, then the expense is included in income. If the casualty occurs in a federally declared disaster area, none of the insurance payments are taxable. For our basis in our property, if a taxpayer's insurance or their payment or their reimbursement is more than their adjusted basis in the destroyed or the damaged or the stolen property, that taxpayer will have a gain on the casualty or the disaster. The gain is going to be equal then to the amount received minus the adjusted basis in the property at the time of the casualty. The taxpayer must then report any gain as income in the year that it's received. All or a portion of the gain can be postponed if the taxpayer purchases a property that is similar or related in service to that property, of the destroyed property, but within a specified replacement period that cost at least as much as the amount that's realized as a result of the casualty or the disaster. Gain is recognized if the amount realized exceeds the cost of that replacement property. And the replacement period begins on the date that the property was damaged or destroyed, and it generally ends 2 years after the close of the first year in which the gain was first taken place or realized. There is an extension, though, if the taxpayer is unable to replace that property, they're having difficulty in finding suitable or similar properties, then an extension can be requested and granted by submitting a letter prior to the replacement period ending and stating the facts of why the taxpayer cannot replace that property within the time limitation. And then an extension can be granted. If the taxpayer's home and their contents are located in a federally declared disaster area, the replacement period generally ends 4 years after the close of that first tax year. For these taxpayers who have lost their records in a disaster or in a casualty, it's essential for tax purposes as well as for getting federal assistance or insurance reimbursement for them to then obtain their records or reconstruct their records. Records that are needed to prove a loss, they will probably have been damaged or destroyed in that casualty. One of my taxpayers explained to me that her home was totally destroyed, and someone called her weeks later, and she had her records in a large plastic container taped up. They ended up, a person called her 10 miles away and said, "I have your records." I thought that was very admirable that they called her, but they located her. But otherwise, it's difficult for them to find these records. A taxpayer, they're permitted to reconstruct their records when they're establishing that the failure to produce adequate records is out of their control because of the fire or the flood or an earthquake or a hurricane. Immediately after a casualty or a disaster loss, a taxpayer should obtain copies of their federal tax returns. The returns can then be helpful in reconstructing their records. They can obtain copies of the last 4 years of their federal tax returns for free from the IRS by submitting a Form 4506. The appropriate disaster then designations, such as Hurricane Maria, is written in red letters across the top of the form. Once the IRS receives this request, and with the disaster designation at the top of the form, they will expedite the processing, and they will also waive the user fee to obtain these records. Sometimes it's a good idea for our taxpayers to make a video recording of their personal property, including the inside and the outside of their home, their garage, any of their sheds or appendages to their home. Another method would be for your taxpayer, if they've had a casualty loss, is to draw a picture of each room, of the kitchen, the bathroom, the bedrooms, with a floor plan. And when they draw this, they are then showing the furniture, the shelves, the tables, any memorabilia that's on on that furniture. These pictures then would serve to be functional in a sense that they would help them remember what they owned prior to that casualty. The taxpayer, they can then obtain catalogs or local advertisements or newspapers from where they purchased their property to establish cost basis as well as fair market value. If items were purchased via a credit card, old credit card statements can be obtained from a credit card company. But proper record keeping, it is essential when a disaster strikes. A business should then try to obtain records that were stored maybe in an electronic format and that they were backed up and stored at a different area. If the business does not have a backup of its destroyed records, they can reconstruct these records by obtaining records from third parties. If the business, then they can obtain copies of invoices from suppliers to then back up their receipts. Bank statements can be used to reconstruct income. But in my practice, as I've started working with more and more of these disaster areas and people who've lost their records, I'm really a big proponent to tell my clients, even if we hope we never have a disaster, I want them, when they loan money or they transfer money, and I always tell them the story of a disaster, I want them to transfer that money or loan that money in even increments, $5,000, $1,000, so that if I ever have to then work with them to reconstruct, then it screams to me that this is probably a loan or a transfer and not income. Copies of prior year tax returns, as well as sales tax reports, payroll tax reports, business licenses, they can be obtained to help in documented business gross sales. If it's impossible to reconstruct the income for the business, the IRS then will use one of three methods to reconstruct the income. And then when they do this, they will use the approach that resulted in the highest income. It is then the responsibility of the business owner to show them why or where their determination is incorrect. The IRS, one of the methods they'll use is they will use the net worth method to show the opening total value of a business and then the ending total value. The difference is then considered income for that year. The IRS, they can also use the bank deposit method, where all deposits are considered income, resulting in that income in most occasions being higher or overstated. The third method is the percentage of a markup method, where they use industry averages. For our deductions, if the taxpayer is unable to reconstruct their deductions, then the Cohen rule is used. And when it's clear that the taxpayer is entitled to the deduction, but they cannot prove the exact amount. Generally, the Cohen rule cannot be used for travel or entertainment or business gifts, listed property, donations, or depreciation. And the Cohen rule that we're talking about comes from a well-known Broadway star in the early 1900s. His famous performance was Give My Regards to Broadway. And he was audited by the Internal Revenue Service, and because he did not keep all of his business receipts, the IRS denied him his business losses. He then appealed and went to tax court. And at that time, he won the agreement that they would allow business deductions as long as they were reasonable in a deduction. And that's what brought us to the Cohen rule now. But if you've ever used the Cohen rule to defend a client, it's normally not going to come out favorable. It's better than nothing, but it's not a favorable. So we do want to try to get records from the third party. Generally, that's going to be a better means for them. If the business does not attempt to reconstruct the destroyed records, the IRS will deny a deduction for all of the expenses. For our companies that have payroll and they use a payroll service, these expenses can be obtained from that service. But if the payroll is prepared in-house, then you can obtain copies of the 941s or the state unemployment from the other agencies. The same as I mentioned with our residential taxpayers, equipment, furniture, fixtures, all of that can be reconstructed by sketching an outline of the inside and outside of that business property and filling in details where the equipment and the furniture is located. The outside can be filled in to document the shrubbery and the signage and the awnings or any other fixtures that they may have outside. Once the business has a list of equipment, then they can attempt to obtain copies of invoices to document their purchases. The depreciation can be reconstructed from prior year tax returns, as well as maybe the personal property tax listing forms from the counties. A copy of a purchase agreement can be obtained from a broker selling the equipment, or maybe for automobiles. The Kelley Blue Book value is a good source for fair market value, as well as a dealer can give a comparable price figure for these taxpayers. After a casualty loss, it's important to take photographs as quickly as possible to establish the extent of the damage. Escrow records are the best evidence for reconstructing records for personal property or real estate property. A taxpayer, they can contact the title company and the bank who handled the purchase contract, or the contractor, or the county or city planning for copies of building plans. The mortgage company, they can provide copies of any appraisals with the cost and the fair market value, with written accounts from people who saw the property before and after the improvements. The licensed appraiser, an insurance agent would be able to establish fair market value. Court records, if the building was inherited, as well as the trust or the estate attorneys that handled the paperwork, and the county assessors, they can obtain old records about that particular property. For you and I, though, representing a taxpayer whose records have been destroyed in a disaster, it is going to be difficult, but it can be done. Prior to the initiation of the audit by the IRS agent, prepare a thorough reconstruction of the business and the tax-related issues. Virtually audit the business's books prior to the IRS audit. Be aware of all of the issues and be ready to address those issues with the IRS agent. As part of the audit, you and I should then prepare T accounts using the taxpayer's cash account records and obtain as much information from the third parties as possible to be used as supporting evidence on the tax returns. Have the taxpayer obtain information for primary evidence as possible, including copies of those invoices and canceled checks, secondary evidence including oral testimonies from third parties. So I think with these disaster losses, pretty much each of us are going to see a casualty loss or a disaster loss in our offices. Any questions that I can answer? And yes, sir. And if Richard, do we have a mic? Say that one more time. I cannot take. Correct. Okay. Okay. Oh my goodness. Wow. So let's talk about that for a moment. So he said, what if, so it gets worse.
But then they travel to the United States because the house go away.
Wow.
Now, let me see. Will we, this different entity, up to speed with what you said with the different distribution agencies alone? Most entities, different entities, take sometimes 2 years to understand what's going on.
I agree. So you're talking about so your comment is, so first of all, I want to set the stage for everyone who did not hear. He has potentially a taxpayer whose windows were blown out in one hurricane, the roof on another hurricane, and then finally the entire house is gone on the third hurricane in less than a month. I mean, all in the Virgin Islands, Puerto Rico and the Virgin Islands. So his question is, this taxpayer then needs to take a distribution from their retirement account, okay, to help then with living expenses and building. His question is that will the financial institutions who are issuing the 1099-Rs be aware of our Relief Act with President Trump, correct? And my comment will be generally not, okay? They're going to get a 1099-R, correct? You and I will then have to attach our statements. I don't believe it's going to be any different, okay? But now we haven't gone through this yet, okay? But I don't think it's going to be any different than when a taxpayer gets a 1099-R, they take the money out of their retirement account and they roll it over and they run the next day to the bank, right? Absolutely, different acknowledgments. In the same year, correct. Now, if we're going to take, absolutely. So so let's go back to the retirement thing first, okay? That 1099-R, you're going to have to paint a story on that tax return. I mean, there's no, and if anyone has any other, absolutely. The 1099-R you're going to get probably will be miscoded and won't be correct. You're going to have to paint the story, okay? But then also, oh, I agree. His comment is the preparer does not have the ability most times to talk to the institution that issues the 1099. I agree. But then part of your tax return, you're going to paint that picture because they're not going to give you a correct code. They don't know, in most cases, a code to then be able to paint the picture. Our job will be to paint that picture. 5498. So when does the 5498 come out, though? In May, right? Good comment. I mean, I like the way you're thinking. It's going to come out in May. He's probably going to do this return. So I think it will help to document it and to paint my story. Absolutely. A good comment. So he says he's going to paint my picture. He's going to document my receipts if we have them, okay? And then when the 54, he's going to go ahead and tell his taxpayer, we may get some correspondence from this. And we're going to document that. Yeah. So his comment is sometimes the agent, when we're talking to them, is not up to the speed. I agree. It's going to be a difficult transaction with that, but you're going to have to paint that story, but also let your taxpayer know this is going to probably get some letters. Hold on, don't panic, and I'm going to paint your story for you. Yeah. What
Marie,
a horrible.
Marie, we've got time for one or two more questions. Okay. I've got a mic back here, so if
Please,
you do, okay.
One or two questions.
In the sum, say for instance, 5,000 or something, will they have to document that in a 1099, or is that just free money?
So you're talking about they receive money from a disaster area, correct?
Yeah. Yes.
This is not considered taxable, okay? Whoops. That will not be considered taxable income.
Is there a limitation on that amount of money?
There is not a limitation on that as long as it's in a federally declared disaster area.
Okay.
And as long as it's for housing or living expenses, okay, still not taxable.
Okay.
Thank you. Good question. Okay. And Richard, she has one up front if you don't have anyone.
All right, where up front?
Right here.
I bet this question has to do with Puerto Rico.
Yeah, we have the Maria hurricane in Puerto Rico.
Yes.
So when you say that when the insurance gives the money to, let's say, to a business, they have two different insurance. One is for business interruption, that they will give you some money back. I'm pretty sure that one is taxable.
That is taxable. So
And, exactly, and then the other one is for the loss. Will
what
that
kind
one-
of loss though? Help me.
Like in the business, like, you know, the.
Inventory or structure
Structures
loss?
and
Okay.
inventory, will
Good.
that one be also taxable?
That will be taxable,
And
but
then you just put the whatever repairs, you know, expenses are?
that's exactly right. They have the ability
Okay.
to replace that property within 2 years generally, but because it's in a disaster area, they have 4 years, okay? If
Okay.
you choose, then that's called an involuntary conversion, okay? But if not, they're going to report it on his income.
So how about, whenever we're gonna do the returns, and we're not sure exactly how much the insurance is gonna give us back, because that's gonna take a little while.
Correct.
For them to,
It
so
is-
how do we estimate
We
the
do not.
amounts?
So the question is, we don't know what the insurance is going to give and how much money. We don't report it until recovery is made or until we believe we're finished with recovery, that we're not going to get any more money, and that's when we report it.
Meaning that we can then, put that amount not on the, taxes before, but after also?
Correct.
Okay.
Yeah,
Thank
good
you.
clarification.
All right, last question back here in the back.
How do you report losses based on a scammer or fraud?
So a scammer or a fraud like a Ponzi scheme? And where's my person? I always like to see my people. I'm sorry. Hey, okay. So a Ponzi scheme? Are you thinking that?
I'm talking about an individual.
Wow, that's a good one. So an individual is involved, so one of those horrible people calls them and says, I'm with the Internal Revenue Service and you owe me $3,000 and bring me cash now. I am not sure, but my first thought is I don't think there's a deduction. Does anyone else in the audience have a comment on that? I have not had that take place. Oh, is she asking about a Ponzi scheme? No, she says no, not a Ponzi scheme.
about an individual who's been hacked.
So an individual who's been hacked, the credit card's been stolen, someone called.
Had, not hacked.
Oh, had, okay. But it's not a Ponzi scheme,
No.
no. I'm not aware of it.
It's extortion or theft.
Say that one more
It
time.
could be considered extortion or theft.
So it could be a theft loss is where you're going?
Yeah.
So it was like a robbery or whatever?
No, it's like someone fraudulently representing themselves.
So, was it a crime?
I would assume so, yes. If it's
Okay.
fraud, it's a crime.
Okay, and there was no conviction, probably.
Probably not.
So then we can take that theft loss on the form, and it's not subject to the casualty losses deduction, as far as the $3,000 for capital loss. Okay,
All right, guys, great questions.
Thank
Due to
you.
time, we're gonna cut. Yeah, let's give Maria a big round of
Thank
applause.
you.